Yo, what's up, you guys? Welcome back to another video. Today we are going to take a look at the market from both a technical and a fundamental perspective. First things first, we do have the NFP data tomorrow. If you don't know what the NFP is one of the biggest news events in the US that determines how many new jobs were added, excluding the payroll sector, which is the farming sector, which is why it's called the non-farm payroll. So it's everyone that excludes people working on the farm for new jobs that got added in that given time or that month that we do look at, right? Now, this is the second time I'm recording this video. First time I recorded it, came through blank. The second time I recorded it, the mic was plugged out. So this is actually the third time I'm recording it. And it's burning hot, plus since it's load shedding. Power's supposed to go on at 4. But let's dive straight into it, right? So the first thing that we're obviously going to look at is the news that came through yesterday, which was directly related to the December meeting that the Federal Reserve had, where they basically gave us an indication of what they were talking about in there, and kind of what we can expect going forward. Now, the way to interpret this information is very simple. There's two things that we take from when the Feds normally speak, and that is any hints on whether they're going to hike interest rates or not. Remember, if there is an indication that they're going to hike interest rate, that is normally good for the index. There's an indication that they're going to reduce the interest rates, it's normally bad for the index. In this case, they've now changed their story based on what they said in December. But let's go through the data, right? It says your Fed officials in December saw rate cuts likely, but path highly uncertain, the minutes showed. So when we came out of December, right, there was a very good chance that the Fed was going to reduce the interest rates, and now they've basically changed their story. It says your Federal Reserve officials in December concluded that interest rate cuts are likely in 2024, though they appear to provide little in a way when that might occur. According to the minutes from the meeting released on Wednesday, at the meeting, the rate-setting Fed Open Market Committee agreed to hold the benchmark rate steady at 5.25 and 5.5 month-over-month and year-over-year. Members indicated that they expect 3/4 percentage point cuts by the end of the year. The question is, it doesn't say exactly when it's going to start. However, the meeting, somebody noted a high level of uncertainty over how or if that will happen. So a lot of uncertainty in the market. Now, how does markets react to uncertainty? It's called consolidation. Doesn't get anywhere. However, one thing we can be looking out for is next week, I believe the 11th of January, we should see somewhere here, we should see the US CPI coming through. Here we go. No, not there. There we go. So we've got the inflation data coming through, which is the US CPI. The way we interpret that information, the CPI is the consumer spending index, which is an indicator used by investors to measure inflation. An increase in inflation means a possibility for an increase in interest rate. A decrease in inflation signals a possible decrease in inflation there as well. So that is the data that we are going to look for. Now we're probably just going to see some either sideways movement or some corrections in the market there as well. The index on the monthly time frame was very interesting. We can clearly see that we're holding on to a live support. I do feel that once the market breaks this level, we are going to go lower, but it requires some high level of data and not trying to guess where the market's going to go for that to happen. What I do see is that we do have the possibility of a pullback in the market, for the market to print what's known as a head and shoulders pattern, and this is considered a bearish pattern from a technical perspective. We also have an impulse. So after an impulse, you expect a correction, taking the Fibonacci from the high to the low over there. We do have the 61.8 lining up perfectly. But the previous level of resistance got broken, acting as support, got broken, now back to acting as a level of resistance. So I do see the index continuing higher, especially with the fact that the Feds are not certain when they're going to hike the interest rate. Now, the way I would obviously play this out, we are in bearish territory. We need to get a clear break and close above this level of resistance here. And then I'd probably close that gap, a pullback to support. Definitely see this market continuing higher. Next up, we do have US30. You can see this chart has already been drawn over here. Now, US30 also in bearish territory. We can see over here, this market had broken below this level over here. This level acted as a level of resistance, broken above that, acted as support, broke below support. All of that supports now resistance. We also have the possibility of the market potentially, printing an information. After an information, you normally expect a pullback to the neckline, also known as the previous level of support, that is acting as a level of resistance here as well. Now, I do expect a slightly deeper pullback in the market, and then definitely see this move take place to the downside. Ideally, we are not going to see this happen just yet. So in order for that to happen, we'll need to get a clear break below this level, because that's the next support that we are faced with. Next up is the NASDAQ. You can see there, I've done this before it even took place, but that's kind of where I see the NASDAQ come pull back. We had a consolidation market, break about the structure, all of that resistance now once again turns support. Now that is definitely expected to move to the downside. Next up, we do have gold. Now gold broke above this level of resistance. When the market was at that level, I explained all of the reasons why I expect to pull back to that previous level of resistance. That is acting as a level of support in the market. Because of the correction that we expect on the index and the negative correlation between the index and the precious metals, the clear break below this level is what we need to see for the market to continue lower, and that would line up perfectly with the previous monthly head and shoulders pattern that we're anticipating on the dollar index, the same way on gold, because they are negatively correlated. And what that means is something when the one increases in value, the other one decreases in value. So because we expect the index to increase in value, by definition, we have to expect the precious metal to decrease in value. Next in line, we've got the S&P 500 also waiting for a clear break below this structure that would give us way for the market to move, continue lower. Now, this was a question that I got from someone. Now, remember, I said we can expect this to complete this W formation, and you can go watch that video I did on GBP, JPY a couple of weeks, I think last week. Okay, now after a W formation, you normally expect to pull back to the neckline, and that is exactly what I'm expecting here. However, the reason we had this move is we had support and the market broke above this level of support, acting as resistance, giving us a clear confirmation. We've entered bullish territory, completed a W formation. Now we're trading it back to the neckline. Thank you for your time. And as always, cheers for years.